All right, so everyone knows what's going on with the chaos of the markets right now. Up, we're down, the interest rates are up and down, kind of we're in the same zone. So I want to give a quick overview of everything where we are. So we'll talk interest rates, stocks, and we're going to talk a little bit of Bitcoin. But basically, what's been dominating the headlines now is tariffs, right? And tariffs are basically taxes. So we're taxing other countries on their goods in here. So at first, everyone thought it was a negotiation strategy on Trump's part, but now it looks like it's actually going to pan out and they're going to do it and put these 25% tariffs on other countries. So there's two ways this kind of goes. And we'll start with our 10-year treasury here. I'll break this down as we go. But basically, by raising the cost of all these goods from other countries, we're going to increase the prices, what it costs to get things, mostly the crap we get from China. Um, Now they're going to retaliate in some way, shape, or form. But barring that, the first things first is going to get more expensive for certain things. So as the price of things go up, people are going to theoretically spend and buy less of these other products. It's what the Fed was doing for the last few years, raising the interest rates, except we just kept still spending. And as much as they want to say everything's still good, we're just on credit cards. So realistically, we're already squeezed to the max here. So any increase in prices will probably trigger us slowing down our purchases, which would then put us into probably a slight recession where we're now not shopping, things are expensive, we're settling back in, and that would then trigger them to lower the interest rates. And by lowering the interest rates, then it'll kind of kickstart housing and things like that. Because the problem we're at with housing is the market's still already sky high. It hasn't really retreated in a lot of areas. And now you're doing that with 7% interest rates. If you drop into the fives or the fours, it's going to get even crazier. And then I think we'll have inflation again. So this is one strategy to really put the brakes on the market, the tariffs, and also bring back American production, because that will bring more people to want to put factories and things back in the United States, so we become more independent. So I think either scenario is we end up with more pain before we, as the rates come down, we rebuild stronger as a country, as opposed to relying on everything else. And then you have the other scarier option, which is, like I said, this is a 10-year treasury, and you look and say, well, inflation's not in the picture, but why does this thing look like we're going to, we could potentially go up? And it is China, because China is one of the biggest holders of our debt, right? They buy the treasury bonds, which that keeps the interest rate market in check. And it's a weird correlation, but basically, if nobody wants to buy the U.S. debt, that rate goes up because they need to entice people to buy it. China has a bunch. If they start offloading the billions that they have, it's going to raise the bond prices, which then in turn will raise the interest rates because everything's factored off of that. So theoretically, looking at this chart, this is where I was originally predicting if we broke through this line, we could end up right in the low fours, get ourselves back to a high fives, low six interest rate. But based on what's going on now, the assessment is if we do end up breaking up higher, we're going, we're going 9-10% on the interest rates. And that would be China retaliating for our tariffs by selling bonds. Because once they do that, I mean, it hurts them as well. So it's not like a thing they could do at any point, because it does, that's their money that, they have tied up in these things. I said, I don't know too much about the whole framework and the details of it. Just know how the overall works, right? And that's all you need sometimes, just a little bit. But basically, that would be a retaliation back for our tariffs, is by not buying our bonds, and they're selling some, would crank our interest rates up. So that's where we're looking on the 10-year side. So this is really a crapshoot now. Could go either way. This is not a good looking chart. You'd want to buy this because you think it's going higher, but going higher is, again, you're talking rates 9-10%, which would lead us into a recession, which is still the same concept, right? We're going to pull back on everything, deal with what we have to deal with, hopefully become more independent, and then kind of come back from there. But this would be the more long onset of, like, we start having some real problems if interest rates go up from here. So that's where we're at on that side of it. Now let's go to the stocks part of things. We are just volatile, right? And this is one of the things I want to zoom in here. When you get to a market top, and I talked about this in my day 4 financial, independence type of workshop where I was going through, like, understanding all of these things, because you don't have to know everything. I can't tell you where the market's going to go today or tomorrow, but we could talk general, right? And you can make a good decision based on probability. So here's where we are. We kind of peaked out in the beginning of December. We've never been able to really crack that high. We did a little bit the other day and then just turned around and dropped. And we've had these big, massive, like, opens up, down, closes up. These are big volatility swings. And usually with volatility means the market turn, market point. So where we're looking now is this chart's a crapshoot. It's like a 50-50, can go either way here. But while it's doing is it's consolidating, and you see the volume start picking up here. So there's something going on. Insiders on one way or the other, either selling or buying. It's a consolidation pattern. But basically, no one knows what's going to happen. This is also in the market of confusion, just like the 10-year treasury. So for your portfolios, you wouldn't be looking at them every day. Probably not good to do. I don't see us personally continuing up too much higher. I mean, I think we're going to bounce around for a while, but there's just a lot the market has to digest from the last 4 years to the new administration, what's going to happen and what's to come. So I just see us kind of bouncing around for a while, not really making any new highs, not really having devastating lows unless something big, like I said, the China counter tariffs, things like that come into play. So that is just a hold. I don't know. I can't tell you what to do there. And then Bitcoin, looking at the same sort of thing. Now, Bitcoin looks a little stronger than the overall market. Like this is a consolidation started, back in November. And it's had the same sort of thing. We hit a new high, we make a new low, we hit a new high, we bounce, have another low. Just a lot of confusion in the overall markets. But if you've looked recently, Bitcoin has been more of an indicator of the market than the market. It's 24 hours, so you can get a good sense of what's going to happen on Monday or over the weekend by following the Bitcoin market. But again, not too much here. This chart looks more positive than any of the other ones. But again, not going to this is going to be subject to what goes on with all of these trades and tariffs things. So something to keep in mind. I think we're in for a little bit of a recession stuff no matter what. There's no way straight up from here. We have to fix some of the things that got us into this mess to get back up. It's just how severe. And once it starts affecting housing, that's when it gets severe. If no one's buying houses, if the interest rates are too high, which it is right now, and it affects the housing market, that's when everything slows down. If you have good housing, you can get through anything, just like we got through COVID because housing, low interest rates, people doing work on their houses, housing spurs the economy. So that's one thing I would hope that Trump knows more about than anybody else is keeping real estate good, because as long as we have that, we can build all these other pillars, right? We're built on housing, but if we can build some more factories and businesses and self-grown stuff, I think that would be the other pillars we can start getting to support ourselves as a country. But that is just the update. I had a lot of requests from the post this morning. So I will keep you posted as we go.